Good morning and welcome to ICG Enterprise Trust's full year results for the 12 months to 31st of January 2026. Before we begin, let me briefly set the scene for today. ICG Enterprise Trust invests in mature, profitable, private companies across North America and Europe, with a strong focus on managing risk as well as returns. Over the past year, our portfolio companies have continued to perform well. We've realized assets above carrying value, and we've returned capital to shareholders through both dividends and buybacks. The portfolio is diversified and supported by a strong balance sheet. Today, Oliver and Colin will walk you through how ICGT has performed, how the portfolio is positioned, and how we're thinking about the year ahead. The slides and the results announcement are available on our website. We will leave time as well for Q&A at the end. You can submit questions at any point using the Q&A box you see on your screens. With that, I'll hand over to Oliver.
Thank you, Martin. Let me take the next few minutes to outline our investment strategy, particularly for newer shareholders. We aim to capture private equity returns while managing risk through a focused investment strategy. Now, our aim is to reduce risk without compromising returns. We reduce risk in the following way. Firstly, we focus only on mature buyouts, profitable cash-generative companies. We do not invest in venture capital or growth since VC adds significant risk and volatility to the portfolio. Secondly, we invest primarily in developed markets, North America and Europe, where the depth and the quality of private equity managers is the strongest. Thirdly, we focus on mid-market deals, companies with an enterprise value of typically 250 million to 2 billion in enterprise value. Small by public market standards, but we think it's a sweet spot of good companies which can be transformed through operational improvements and strategic repositioning into market-leading great companies. Now, we aim to also generate obviously high returns, and we do this by partnering with top-tier private equity managers with proven track records through the cycles. And put together, that gives us a diversified portfolio of resilient companies with a more consistent return profile where performance is less cyclical or seasonal. And let me unpack this, what we mean by resilient companies. In practice, we look for companies with the following characteristics. They have an established market position. They are a provider of mission-critical products or services. And we also like investing in businesses which have pricing power and a high-margin business model. And we're, as we all know, are currently living in a volatile macroeconomic climate. But we believe that these characteristics give our portfolio resilience and flexibility in the face of market turbulence. And that's why we believe ICG Enterprise Trust can play a valuable role in many shareholders' portfolios. We believe our high realization rate of roughly 20 to 25% of NAV is good evidence that we can select and get exposure to companies with resilient growth. Market-leading companies find buyers even in difficult market environment. In recent months, there have been various announcements in the investment trust space. However, ICGT's board and us as a manager have already for a number of years been making refinements and enhancements to the shareholder proposition of ICG Enterprise Trust. And this slide summarizes a number of initiatives that we have implemented over the years. First, on our investment strategy, we've continued to refine their approach. In 2023, we announced a 50-50 target split between North America and Europe. And last year, we increased our focus on secondary and direct investments. And lastly, we have invested in a dedicated investment team focused on the ICG Enterprise Trust portfolio, which has delivered an 11.8% annualized portfolio return on a local currency basis over the last 5 years. Moving to capital allocation, we have a progressive dividend policy with the ordinary dividend per share increasing for 13 consecutive years. The board was also an early mover on buybacks, launching a long-term program in 2022 and an opportunistic program in 2024. And combined, 4 to 5% of NAV has been returned to shareholders in each of those last 2 financial years. In regards to communication and engagement, we have enhanced our look-through disclosure on the portfolio. We met a record number of investors last year, and we broadened our outreach across channels, including an increased LinkedIn presence, platform engagement, and shorter form video contents. And collectively, these actions have supported a 17.3 share price total return in the 12 months to 31st January 2026. Now, we should turn to our performance for this financial year. On a local currency basis, the portfolio returned 4.8%. As many of you will be aware, unfortunately, sterling strengthened sharply against the US dollar in one of the biggest 12-month moves in the decade, which created a 3.6% foreign currency headwind. Therefore, the one-year NAV per share total return was 0.5%. Over 5 years and 10 years, we've produced double-digit returns. In the last 5 years, NAV per share total return has been 10% annualized, and the share price total return was 13% annualized. We also returned 51 million pounds through capital allocation during the year, and 28 million pounds of that via share buybacks. Lastly, we've been actively managing our balance sheet, and we're particularly proud that we can continue to be supported by a very robust balance sheet, high liquidity, and low net debt of 2.5% of portfolio value, which gives us flexibility to keep deploying into high-quality opportunities and maintain vintage diversification, which is so important in private equity to support our long-term growth objectives. Before we go into the detail of our fiscal year 26 investment activity, I want to frame the discussion with 4 key points. Firstly, the underlying private company fundamentals remain very robust. Secondly, the enterprise trust is actively managed. Thirdly, I want to specifically touch on certain elements of recent market volatility. And finally, I want to expand on the long-term growth trends that our portfolio taps into. So let's start with the first point. Underlying private company fundamentals remain robust. Over the last 12 months, the enterprise trust portfolio delivered 13% earnings growth. And this chart shows here the annual EBITDA growth for ICG Enterprise Trust portfolio, a basket of around 1,500 European and US private companies from a proprietary ICG database and the FTSE All-Share. And I think the message is quite simple. Private companies have outperformed public markets. But furthermore, our portfolio has outperformed even that private benchmark. Our portfolio EBITDA growth has averaged 15% per year, compared with 6% for the FTSE All-Share. That consistency is what underpins our long-term compounding returns. Moving on to the second point is that Enterprise Trust has a dedicated investment team, and therefore we have the ability to actively manage the Enterprise Trust portfolio, both in how we build the portfolio, but also how we allocate capital. On the left-hand side of the slide is portfolio activity. And Colin will cover some of the specifics shortly, but I wanted to get across here is that fundamentally we are very selective. We're highly selective in re-ups to managers, focusing on those who continue to generate strong performance and attractive co-investment deal flow. We're not just doing the re-ups. We're also highly selective on co-investments, executing 6 deals and reviewing further 25. This is consistent with our approach of typically turning down over 80% of our co-investments we offer. On the right-hand side is capital allocation. We bought back 3% of our share count during the year and over 9% since launching the long-term buyback program in 2022. Buybacks sit alongside our progressive dividend policy. Total dividends for fiscal year 26 are 39p per share. It's the 13th, and I mentioned this before, but I think it's worthwhile mentioning again. It's the 13th consecutive year of ordinary dividend per share increase and an 8% increase on last year. In In total, we have returned 51 million pounds this financial year, representing approximately 4% of our opening NAV. Now, my third point is recent market volatility, particularly in public software companies, and what that could mean for private markets and marks over the coming quarters. Our view is that software businesses can be very attractive investments due to high margins, recurring revenue, low capex, and growth from ongoing digitalization. So these are very strong business models. However, that attractiveness has often translated into very high valuations. And the emergence of AI is now challenging software company valuations, particularly those which do not have deep domain expertise. And our approach in ICG Enterprise Trust has been very disciplined. Over recent years, we have declined a number of excellent software companies because we did not think valuations were sustainable. As a result, software is only 12% of the portfolio, which we believe that is meaningfully below the private market average. Where we do invest tends to be in mission-critical software, accounting, payroll, compliance, security, which we view as resilient, and in every case, we invested only after stress testing the impact of lower exit and contraction of exit multiples. At year-end, the average multiple of our software holdings was 21.6 versus 27 for the S&P 500 Software Industry Index. So I think the message here is quite simple. As public market movements feed through the private valuations, we believe our limited exposure, the quality of the assets, and our valuation discipline should help support resilience. This is clearly an area we will be particularly focused on in coming quarters. Now, let's also touch briefly on foreign currency. Fluctuations in pounds and US dollars over the last year won't be news to anyone. It has negatively impacted our performance on a pound basis. However, over the last 5 and 10 years, the impact of foreign currency moves has been broadly neutral. Private equity is, at the end of the day, a long-term natural hedge. Moving on to our fourth and final point is the breadth of long-term growth trends across the portfolio. As I mentioned before, we have a dedicated investment team, so we were able to actively build a portfolio to benefit from multiple structural tailwinds. And you can see that reflected in some of the logos on the slide. And I'd like to pick out Brooks Automation, which is a provider of semiconductor manufacturing solutions and benefits from the rapid digital advancements in technology and productivity. It directly benefits from what's happening in the AI sector. Curium is the leading provider of nuclear imaging solutions, benefiting from the trend of increasing healthcare expenditure and an aging population. And we've had a nice exit, proving that this was a great investment. European Camping Group is the European leader owning and operating camping sites across Europe, benefiting from consumer spending patterns to more experience-led and convenience-driven purchases. Lastly, Stout is a specialist professional services firm providing valuation services to address regulatory compliance and benefits from the growth of increasing regulation and financial infrastructure across economies. Anyone who is in the financial service industry and operating knows that regulatory compliance is not decreasing. If anything, it's consistently increasing. So we're benefiting from that trend. These are the kinds of tailwinds that can support growth through different economic environments and are central to our objective of delivering attractive compounding returns. Now, with that context, I'll hand over to Colm to take you through the fiscal year 26 activity in more detail.
Fantastic. Thanks, Oliver, and good morning, everyone. So over the next few slides, I'll take you through what we saw across the portfolio over the last 12 months. As a reminder, we think about the investment cycle in 4 phases. First, we commit to new funds. with our US and European managers. Secondly, that capital is drawn and invested in portfolio companies, or we invest in those companies directly. Third, managers create value in those businesses, and we like to partner with managers who have a strong focus on operational expertise to optimize that growth. And finally, the investments are exited and proceeds realized. The cycle then repeats as proceeds are recycled into new commitments and into new investments. So moving on to the next slide and starting with commitments. We made £201 million worth of new fund commitments during the year. Most of that went to established managers with whom we have long-standing relationships, such as New Mountain, THL, and Advent. During the year, we focused mainly on existing managers, though some, such as Integrum, are relatively new additions to our portfolio. Like most of our managers, people like Integrum offer a strong relationship with the broader ICG group, a long track record and low loss ratios, and the potential to generate meaningful co-investment deal flow. Now moving to new investments. We invested £194 million during the period. That was slightly above last year, but as Oliver noted, we remain selective and activity is below our 5-year average. On the right are the largest investments, and you can see they span themes ranging from food distribution, professional services, even to pest control. That's quite the range. It emphasizes the diversity in the portfolio. Let me bring this to life with one example, which is Global Market Foods. Moving on to the next slide. Global Market Foods is a Chicago-based importer and distributor of international foods for the US market. It has a strong financial profile, it's grown through multiple downturns, and it still has several different avenues or levers for expansion and growth. These include M&A, it's a very fragmented market. There's also the scope for geographical and product expansion. We co-invested $15 million alongside Audax. It's a manager we first backed in 2023. Audax has a combination of sector expertise, but they also have a specific expertise in executing buy and build strategies. And that's really central to the value creation plan for this investment. And that further underlines the theme of backing experienced, high quality managers who have, as the Americans would say, a right to win in these kinds of investments. Moving now to portfolio company performance. This slide summarizes the key performance and valuation metrics across the portfolio. And as you can see, portfolio companies performed well, delivering 10% annual revenue growth and 13% annual EBITDA growth. Valuation multiples rose modestly to 15.7 times LTM EBITDA. We're comfortable with that, given the quality of the portfolio, its diverse sectoral exposure, and its defensive qualities. Finally, turning to exits, realizations totaled £382 million in the period. And overall, it was a strong year for realizations. Whilst the 2025 global buyout realization rate remains subdued at around 14%, that's broadly in line with 2022 to 2024, our realization rate was 25%. We generated liquidity from 9 of our top 20 companies during the year. Just as important was the breadth of exits from Minimax, Fire Protection Services, Fronieri, Ice Cream, Datasite, PSB Academy, reflecting again the range of themes and growth drivers in the portfolio. The common thread is our focus on high quality businesses and high quality managers who are able to execute exits even in a comparatively tough market. It also shows the benefits of exit optionality that comes with our mid-market focus. We are not especially reliant on IPOs, with multiple exit routes, including sales to financial buyers, strategics, and to continuation funds. Moving on to the next slide, but staying with exits, one of the clearest proof points for NAV is where businesses are sold. Over the last 12 months, ICG Enterprise Trust saw 49 full exits at a multiple of cost of 3 times, and that was with an 11% uplift to the previous carrying value. That extends a long-term pattern. Exits have generated about 2.5 times cost and have typically come at a significant premium to carrying value. We see that as a strong validation of both the portfolio quality and the veracity of the NAV. That realization activity, as you can see from this slide, also leaves us well positioned from a balance sheet perspective. At the 31st of January 2026, we had £227 million of available liquidity. We had £33 million worth of net debt, and that's against a £1.4 billion portfolio. That converts to an overcommitment ratio of 32%. We believe that leaves us with one of the lowest gearing ratios in the peer group. Balance sheet discipline is particularly important in this environment, and it remains a core strength of ICG Enterprise Trust. Specifically, it allows us to keep investing in high quality opportunities through the cycle. It allows us to maintain vintage diversification, and it enables us to enhance shareholder returns through the use of buybacks and dividends. So finally, looking ahead, our priorities are clear. First, we will keep a high bar for new investments. We will continue, as Oliver outlined, to manage the portfolio actively. Secondly, after a strong realization year, several larger positions have been exited. And over time, we aim to rebuild that concentration when we can see the potential to generate outsized returns. And third, we will continue to balance long-term value creation with near-term shareholder returns through investing, through buybacks, through dividends. There are, of course, still uncertainties, not least of which is how far will volatility in software valuations feed through to private markets over the coming quarters? To what extent will the conflict in the Middle East affect inflation, interest rates? What will be the other second order and third order effects? And also, how will transaction activity adjust to that external environment? Despite all of this, we believe we are well positioned with a balance sheet that gives us flexibility to keep investing, to maintain vintage diversification, with a resilient mid-market portfolio, diversified by sector and diversified, crucially, by investment thesis, and with strong partnerships with managers that have navigated through multiple cycles and multiple different types of market environments. And we believe collectively that supports resilience through volatility and enables compounding returns over time. And with that, I'm going to hand back to Martin for the Q&A.